Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today in episode 313, we're going to talk about health savings accounts, HSAs. I mentioned in a couple of episodes, 2 or 3 episodes ago, that I got spooked. And it's where I think I know something about, I guess, money, personal finance. Something seems kind of basic to me. I think I've got it all figured out. And then I realized I was totally wrong about something. Well, that happened again. It's like twice in 1 month. Not a good month. It happened again with HSAs, and so I'm going to talk about them today and how to use them, how not to use them, and a gotcha that almost got me, but fortunately it didn't. So that's what we're going to cover today. For you folks that are watching on YouTube, I am trying something a little different today, and that is rather than just a camera where you poor souls have to look at me just talking, you can also see my screen on my computer. Now, for today's episode, I'm not sure it'll be all that critical, but when we get into things like investing, maybe I jump into, I'm doing this now just for no good reason, but I jump into Morningstar and I want to look at a fund and talk about something about that fund and what Morningstar can show us and what we can learn from it. I think it's helpful for you guys if you can see it. So if you're listening to the podcast, you might want to check out the YouTube video. Again, the good news is you won't just have to look at my big melon on your screen chatting away. I'll try to reduce it and stick me in the corner so you can see the important stuff. So that's what I'm trying to do today for this show. And we'll see. It could be a complete failure. We'll find out. Because by the way, if it is, you know me. I ain't recording this over again. This is it. So anyway, that's the plan. Health savings accounts. And I'm going to tell you everything I know about them. And they are, I think, one of the best tax-advantaged accounts you can get today. And I have one. And I wish I'd set mine up earlier. But I didn't have a high deductible health plan back in the day when I could have. And that's a whole nother story. So I've only had one for a couple of years, but I'm continuing to use it. And it's a great savings vehicle. Not only, here's the thing, as you'll learn here, it's not only for savings for medical expenses, although that's its intended use and it's great for doing that, but it's also a great way to save for retirement. It's even, in theory, kind of a reasonable way to save for emergencies, kind of, but we'll talk about that. So let's dive right in, and here we go. Bear with me. Okay, health savings accounts. By the way, for those watching on YouTube, you'll see that I have this in presentation mode, and as I move my cursor, it turns sort of a trailing blue. So if I go silent on the podcast, it's probably because I've just become completely mesmerized by the blue streak that I'm now moving back and forth across my screen. All right, enough of the nonsense. Health savings accounts. Real quick before we get to them, I've been getting a lot of emails with some great questions from you guys. I read them all. And I'm going to be addressing them, some probably as a collective group in a future show. Some of them, are such that really they could be the subject of an entire podcast. So I haven't forgotten about you. If you've emailed me, I guarantee you I've read it. I've responded to a couple, but they are going to be part of the show. So keep sending them in, dr@doughroller.net. Some excellent questions, and have really enjoyed reading those emails. So please don't hesitate to shoot me an email, dr@doughroller.net. All right, health savings accounts. Let's start with what the heck they are. So they're basically a tax-advantaged way to save for medical expenses. And but here's the trick. Not everyone can open up an HSA. You have to qualify. Isn't that always the case? You got Roth IRAs. There's qualifications with income and all that sort of thing. There's always catches. Well, there's catches with HSAs. And the first big one is to qualify, you have to have what they call a high deductible health plan. High deductible health plan, HDHP. You'll see it abbreviated. Now, what is that? Well, for an individual, it's a health plan where the deductible is at least $1,300. And if you're a family, which really would mean a couple or with or without children, then you have to have a plan that has a deductible of at least $2,600. Now, a couple of things to note about that. First of all, those numbers change every year. Last year it was a little bit less than that. Next year We're in 2019, I should say, for those that might listen to this show down the road. In 2020, it could be adjusted upward. So it does change from year to year. The other thing is, there are actually some other technical to my mind anyway, requirements for a plan to be designated as a high deductible health plan. The good news is you don't really have to dive into all of that. For an employer, if they'll identify which plans qualify for health savings account, which plans are high deductible health plans, and you can always ask your HR department if you're buying insurance on your own through the exchanges or not. The plans are usually clearly marked as either qualifying you for an HSA or not. So, but you want to make sure that you get that right. So again, in 2019, for an individual, the plan has to have a deductible of at least $1,300. For a family, at least $2,600, and that's important to know. Now, once you qualify for an HSA, what are the tax benefits it gets you? Well, there are really three, right? So the contributions to an HSA are tax deductible. They will not be added to your taxable income, and this is actually where the gotcha for me came in, which I'll explain in a minute. But that's the first benefit. You get a tax deduction, very similar to a tax deduction you'd get for contributing to a 401k or deductible IRA. So that's the first one. The money in an HSA grows tax deferred, we'll call it for a moment. That is to say, as you earn dividends on your investments, interest, as the value of your investments appreciate, you don't get taxed year to year on those gains. That's the second one. The third one is, if you spend the money on qualified medical expenses, you can do so tax-free. So an HSA, it's kind of like combining a tax-deductible, say 401k or IRA, with a Roth 401k or IRA, melding them together. You'll see sometimes it's described sort of a triple tax advantage. You get a tax advantage when you contribute, you get a tax advantage while your money stays in the account, and then you get a tax advantage, tax benefit when you spend the money, so long as it's for a qualified medical expense. And that combination of tax advantages makes it the best, most tax advantaged account that we have access to. So it's terrific. Now, that raises a couple of questions, right? How much money can we contribute to one of these accounts? I mean, we'd like to shove as much in there as we can. Here's the deal. If you're single, the limit is $3,500. Again, that's in 2019. That limit can and will change from year to year. If you're part of a family, it's twice that, $7,000. Also, there are catch-up contributions. Now, this is where you have to realize that the HSA rules are different than 401ks and IRAs in a couple of important ways, and this is one of them. So there is a catch-up contribution, whether you're single or family, and it's $1,000, but you have to be 55 or older. You may recall from a 401k or an IRA, you can make a catch-up contribution beginning at age 50. Not with HSAs, it's 55 or older. Now, one question that raised for me was, we're a family plan, my wife and I, and we're not the same age. And one of us is 55 or older, one of us is not. Just in case my wife is watching this, I'm not going to say which one's 55. However, that raised the question, well, can we do the catch-up or not? Now, I spent a little bit of time researching that. Here's what my takeaway is. The account holder has to be 55 or older. In this case, that would be me. So this is kind of going to give it away, but we cannot, I'm sorry to say, make the catch-up contribution at this point. That being said, I will say I look a lot older than my wife, if that helps. Sweetie, I hope you're not watching this or listening to the show. Okay, that's the contribution limits. Now, one of several, as we've already talked about, but important and very significant benefits of an HSA is this. You don't have to use it every year. With a flexible spending account, it was use it or lose it. With an HSA, it's use it or don't lose it. I mean, you can hold on to this account and let it roll over from year to year forever. There's no I guess I should be careful when I say forever. I think it's forever. There's no limit, right? I could put money in this year and use it for medical expenses 20 years from now, right? It's not as if I've got to deplete my account every year or I lose it, right? Now, that's an important feature because what it means is, well, it means a couple of things. One is we don't have to fear that we're going to put too much in, right? I don't know if you've dealt with this. I remember this from years ago when we were doing a flexible spending account. It was always, how much should I put in? I mean, I don't want to put money into the flexible spending account and then lose it because we don't have enough medical expenses for the year. Of course, you don't want to, inflate your medical expenses just to use the money. And so almost without fail, we put in less than we ended up needing just because we were scared of putting money in and then not getting an opportunity to use it. So with an HSA, you don't have to worry about that. The other thing is, because you don't have to use it every year, it's actually a great way to save for retirement, which we're going to talk about a little more here in a couple of minutes. But it is a good retirement vehicle. And in theory, you could even use it for emergencies or just future spending. It's actually a good strategy for folks that want to retire early and have to deal with the question of how do we get access to our retirement accounts if you retire, say, before you're 59 and a half. And that brings me sort of to a strategy, and it's this. You can contribute money to the HSA but not use it, right? Now, of course, if your finances are such that you're using it every year for medical expenses, that's sort of a different situation. Obviously, if that's what you need to do, that's what you need to do, and that's really what an HSA is intended for. But if you have the ability not to use it, you can just let it grow. Then one strategy is, as you incur medical expenses that you're just going to pay out of, say, your regular checking account, save your receipts, save them all. And you can save them for years to come. And if you have a $500 medical expense this year, as an example, you could hold on to that and 10 years from now, take that $500 with that receipt out of your HSA. And it would be tax-free, assuming, again, it's a qualified medical expense. In other words, you don't have to take the money out of the HSA in the same year you incurred the medical expense. Now, you have to have had the HSA when you incurred the medical expense. If you set up an HSA, let's say in 2019, for the very first time, you can't go back to a 2017 expense that maybe you saved, right? Because you didn't have an HSA back then. But if you've got an HSA now, you incur an expense, you can hold on to the receipt, and then sometime in the future, when you need that money, you can take it out with that receipt. And so that can make it a good way to save potentially for emergencies. It can also be a good way to have access to money if you retire early, right? Now, that raises another difference between HSAs and 401ks and IRAs. What happens if you spend money out of an HSA that's not for qualified medical expenses? Well, two things happen, potentially. Well, one always happens, and another one might happen. The first one is you'll pay income tax. It'll be considered taxable income because you didn't use it for qualified medical expense. Now, the second thing is you could potentially get a penalty. You know how you take money out of a 401k or an IRA early, early meaning 59 and a half, you get hit with a 10% penalty. Well, an HSA has the same mechanism, but the numbers are different. So first of all, it's not a 10% penalty, it's a 20% penalty. You really get walloped. And secondly, it's not 59 and a half, it's 65. So I think it was maybe the IRS, or I guess Congress's way of saying, we're giving you some really rich benefits with this account. But if you don't use them for qualified medical expenses, we're really going to hit you over the head. We're going to double the penalty from what we're used to, 10% to 20%. And we're going to make you pay it all the way until you're 65. Once you hit 65, then you can take the money out for non-qualified medical expenses without paying the penalty. You still, of course, pay the income tax. So kind of a lot to keep in mind, but still a very good account for retirement. Now, in my mind, my hope is that we always use it for qualified medical expenses. And my thinking is I don't save every receipt. I save the big ones, in our case, what we do is tend to save any receipts of $100 or more. I guess I could save every receipt, and maybe that's what you'll choose to do. But when you've got a $10 copay, I just find that overwhelming to save those smaller receipts. But again, what you do is up to you. And so my thinking is, by the time we hit retirement age, we'll have presumably saved, I'm assuming thousands of dollars in medical bills that we've paid that we could use to take money out of the HSA. And then, of course, as you get older, you tend to have more medical expenses. So I kind of view the HSA really as what we'll use in retirement during what I consider retirement age, which we're not there yet, but getting there. We'll use the HSA for medical expenses that you tend to incur as you get older. That's our current thinking for how we're going to use the HSA. Now, if you want to follow this approach, if you're going to use the money every year, if you need to use it every year, then some of the things I'm going to talk about now may not be as important to you, as you'll see in a minute. But if you're going to use it as an investment vehicle, finding the best HSA is really important. Where do you open it up? Now, some things to consider, and I've got them here. The first one is what's called first dollar investing. The way some HSAs work, you can invest the money in index funds or different mutual funds, but they require you to keep a minimum amount in a cash account where you're earning, you might earn a little bit of interest or not, but it's not a great deal. And I've got one now that requires us to keep, I believe it's $1,000 in this sort of cash account. I don't want to keep $1,000 in the cash account. I want it all invested. And so I want to find an HSA where there's first dollar investing, right? So that's the first thing you want to consider. And I'm going to give you a couple of what I think are good options in a minute. But that's the first thing. The second thing, of course, is you want to find an account with low fees. I think all of them have some kind of fees generally, but you want to find options with low fees. And by fees here, I mean account maintenance fees that you'll pay to the HSA provider. And then the third thing is you want to look at investment options. You want low-cost index investment options, and they're out there. They have Vanguard funds, they have some Dimensional Fund Advisor funds, DFA funds, and so they're definitely out there. But you want to consider what the investment options are in the HSA before you select it. So those are my primary criteria: first dollar investing, low maintenance fees, and low-cost index fund options for investments. Now, the two that I like the most, and I'm actually going to show you this on the screen for those watching. Fidelity is the first one. Fidelity has a health savings account that, in talking to a lot of people, is really good. You've got great investment options. There's basically no fees. And there's first dollar investing. This is where I'm going to, as I'll explain in a minute, going to keep one of my HSAs, and I'll get to what I'm doing in just a second. But I think it's a great option. And Fidelity, it's interesting. As an aside, you may have heard that Fidelity has recently come out with some index funds that have zero management fees. Their expense ratio is 0 bips, right? 0 basis points. That's pretty cheap. Now, I started digging into those funds, and I have a couple of questions that I'm trying to answer. One is, the expense ratio does not include the cost of trades that a fund has to make. And the reason it doesn't is because a mutual fund can't know ahead of time exactly how much it's going to spend buying and selling stocks and bonds, right? So it can't really put that in an expense ratio. What that means is you could have two funds that, let's just say, make up a number, 10 basis points each. But one could actually be significantly more expensive because it's buying and selling stocks and bonds a lot more than the other fund. And those expenses come out of your pocket, right? They charge those expenses to the investor, but they just don't get reflected in the expense ratio. So I'm in the process of digging through trading costs for some of these funds, and I'm going to share that with you in a future podcast, right? The second thing, and so this maybe I can get into Morningstar after all. For you guys watching on YouTube, if I can find this fund, I have to remember the name of it. Fidelity Zero Fee Funds. It's their total market. They have a total market fund. I think it's this one, FZROX. So if we go to FZROX, and this may not be the right one, so bear with me. One thing I noticed about these funds, and I actually asked Fidelity on Twitter about this, and their response was, we'd love to answer your question, but we're not going to do it over Twitter. That was fine. That's not the fund I was looking at. It was, maybe it's FNILX. FNILX. It's not showing up. That's weird. Not showing up in Morningstar. Well, I'm going to try one more, and then I'm going to give up. VZILX. Oh, here it is. Yeah, this is the fund. So this is their international index fund. That's right. It was international fund. The reason this caught my eye was I moved some of our investments from Vanguard's target date retirement funds to basically just a 3-fund portfolio. And the reason was because I could lower my expenses. I think the Vanguard target date was charging, I want to say 14 bips. And I could get it for 4 or 5 bips on the bond fund and the US fund. But the international fund, I think, was 11 basis points, as I recall. And I thought, I want to get lower than that. And I knew that Fidelity had an international index fund that had 0 basis points. But if you're looking here on YouTube, and for those that are not, I'll just read it to you. It's holding 6.42% in cash. That's a heck of a lot of cash. Vanguard's international fund was holding like 1%. That's a pretty significant amount that will have a drag on returns. And in fact, and this was, this is a very short period of time because this is a fairly new fund for Fidelity. But year to date, I think the Vanguard fund was up 20 basis points above the Fidelity fund. Now, again, it's only 4 months, less than that. And so that's not really meaningful, but it's only data that I have. And of course, that performance is after fees. That's even factoring in Vanguard's 11 bips. I think it was 11. It could have been 14, whatever it was. And I wonder how much of that is because Fidelity is holding 6.42% in cash. By the way, that was the question I asked on Twitter. I thought they could answer that. It's not, specific to my account. But in any event, I'm going to try to figure that out and report back to you. The point of all of that, I know I've gotten far afield from health savings accounts, is that it's terrific that Fidelity's got funds that are 0, have no expense ratio. But that's not the only factor to consider, right? When you're comparing, say, 2 index funds, both of which are extremely inexpensive. One is 0, one's a few bips or 10 bips. You've got to look at more than just the expense ratio. You've got to look at trading costs, among other things. And if they're holding what seems like an unusually high amount of cash, you have to ask why. Why is that? And maybe they have a good reason, and maybe it's temporary. I don't know. I am going to figure that out, and I will report back to you. All right, let's get back to HSAs. And bear with me. Okay. So Fidelity. Fidelity is the first one that offers, I think, a really good HSA. The second one is livelyme.com, LIVELYME.com. It's sort of a fintech company that started out, and they seem to be great. First dollar investing, low expenses. I believe they use TD Ameritrade for their investments, and you can basically invest in just about whatever you want through TD Ameritrade. There can be expenses based on the trades, so you've got to deal with that issue. But I think livelyme.com and Fidelity are 2 really good options. By the way, if you think you've got a great HSA, we'd love to hear about it. Just join the Facebook group, doorroller.net/Facebook group, and let us, tell us about it. And of course, you can always send me an email, dr@doorroller.net. Now we get to the issue where I got spooked And maybe a question some of you are asking as you listen to this podcast, and that's the following. Rob, you might say, I think Fidelity and Lively Me, they sound fantastic, but I have an employer and that's not who they've chosen. They've chosen Optum or Optimum, is that one of them, and My Benefits Wallet, or they've chosen someone else. And do I have a say in that? I mean, can I contribute separately? How does that work? Well, this is what almost tripped me up. So number one, if your employer contributes part of your money to the HSA, they're obviously going to contribute to the HSA they've chosen. And there's nothing you can do about that. But it's free money. Well, free. I mean, it's part of your compensation package, but you're obviously going to want to take advantage of it. And it's going to go into the HSA that they've chosen. Fine. Now, then the question becomes, to the extent you're going to contribute beyond that, do you contribute out of your paycheck, have it just taken right out of your paycheck and put into your employer's HSA, just like they do with, say, a 401k? Or do you say, no, employer, don't withhold that from my paycheck. I'm going to contribute myself on my own to, say, Fidelity or Lively Me or your HSA of choice. At one point earlier this year, I thought, I'm going to pick Fidelity and I'll let my employer put its contributions into the HSA it's chosen. But for my contributions, I'm going to contribute directly to Fidelity. It turns out that would have been a big mistake. And here's why. I can do it, and I can deduct the amount from my taxes at the end of the year. It's kind of like an IRA in that sense, though. I've got to remember to actually take the deduction, but it's permissible, and I can do that. But here's the catch. Here's what spooked me. If you let your employer take the money out of your paycheck, not only does it come off of your taxable income, again, in that sense, it's really no different. I suppose it's a little easier because your employer does it for you, but from a tax perspective, no real difference. But here's the thing. It also doesn't get hit with payroll taxes, Social Security, and Medicare. And that's a big savings. Now, some of you may max out your Social Security with or without the factoring in the HSA contributions. But as we all know, Medicare, there is no limit, right? And for those that don't max out contributions, I'm sure that's not really the right word, is it? Taxes, I'll call it, to Social Security, it's a no-brainer. You really want your employer to take that money out, and you avoid the payroll taxes. They, of course, deduct it from your taxable income on your W-2, so that's done for you. So any sort of fees that you may have to pay through your employer's HSA are unlikely, I think, to exceed what you're going to save from keeping your HSA contributions out of your taxable income, including payroll taxes. And that was an issue I hadn't considered. And as I think about it, I don't remember how I stumbled onto that issue. I was reading some article, but in any event, I'm glad I did. So I'm continuing to contribute through my employer. And here's the deal. Once you leave your employer, you can transfer your HSA anywhere you want, just like you can your 401k. So I have an HSA from a previous employer, and I'm in the process of transferring it to Fidelity. Now, I've talked about how to transfer accounts in the past. So just a reminder, I would do the same thing with an HSA. The first thing I would do is call, in this case, Fidelity, but call the company that I want to transfer the account to, right? Because, of course, they're going to be all motivated to help you because they want your business. So in my case, call Fidelity first. Now, of course, I'm going to have to reach out to the company that holds my former employer's HSA. But Fidelity, and I found this to be true with Vanguard, sort of get you the documents you need, helps you walk through it. In the case of Fidelity, they'll have to help me set up the HSA account. No big deal. I'll transfer my old HSA to Fidelity. By the way, my old HSA, high expenses. They do not have first dollar investing. Their investing options are mediocre. And I'll go over to Fidelity and I'll put it in their zero cost mutual funds. Yes, I've got some research to do on why they're holding so much cash in their international fund. But at the end of the day, it's still a great investment. And I'll be able to put all of my HSA money that's in that account into mutual funds to invest all of it. And then with the one that I'm currently contributing to, eventually I'll do the exact same thing with that one. Roll it over right into what will then be my existing Fidelity account. Well, I've covered a lot today, and I hope you're all with me. If you have questions, if you think that I've missed something that I should have covered, maybe you think I should have gone into something in more detail, would love to hear from you. dr@doorroller.net. Again, maybe you've got an HSA you love that you think is worth sharing. Shoot me an email, dr@doorroller.net. Would love to mention it in an upcoming show. As I promised at the beginning of this episode, I am going to get to your questions. In fact, I'll be starting to do that with the next show. Some great questions are coming in, but keep them coming, dr@doorroller.net. And would love to have you join the Facebook group, doorroller.net/Facebook group. I think it's 6,500. I'm not sure. Let's check it out real quick. Facebook. I think it's 6,500 folks. Whoops, I got to log in. You can tell I don't go to Facebook. The only time I really go to Facebook is when I go to our group. That's it. So let's see. Oh, and one person wants to join. We've got 6,652 members. All right. And the questions are great. You know, I'm looking through it now. Like here's one that asked a question, 36 comments. Here's another one, 27 comments. Here's one with 2. A member named John posted, I guess Paul Merriman had updated one of his target date, ultimate target date fund portfolios. So that's a great link. Here's another one, 23 comments. Just right down the list, 42 comments. I mean, it's a very active group, and the folks do a great job of, sharing what they know, sharing their experiences. Please don't be intimidated, thinking that your question won't be viewed well. It's a really friendly group, and I'm grateful for the folks that contribute to it. I think it helps people figure out all this money stuff, and we all could use some help. Well, I got nothing else to say today, so I hope you have a great day and a great week. Until next time, remember, the best thing money can buy is financial freedom.